Our next guest says investors should stick with that trade despite those outsized returns. Here at Post 9, Sara Naison-Tarajano of Goldman Sachs Private Wealth. Nice to have you back.
Great to be back. Thanks for having me.
Of course. So I just had a conversation I hope you heard with a couple people pretty bullish.
Yeah.
Is that the way, that's where the trend is here?
Yeah, look, I'm constructive. I don't think I'm expecting the type of returns that I expected when I was here with you in November.
Well, with the gain since then, S&P's up 15, and these are percent, and the Nasdaq's up 17.5% since you were last here in November, right. And we're pretty positive.
So I'm constructive. I think, the economic data is strong. Earnings have been strong with 67% of companies having reported, 57% having beat. That's, the average beating is below 50%, typically more like 48%. So I think the economic data and the earnings are supportive. And I think, our perspective on inflation is it's continued to wane. These are all things that are pretty supportive for the equity markets generally.
Has the easy money, so to speak, been made since November 1st? Is it going to get a little tougher or perhaps not? How would you answer that?
So I think it will get a little bit tougher. I mean, if you look at our kind of global investment research target, it's 5,100. We're pretty much right there. I think there's some upside risk to that number.
Everybody keeps bumping their numbers up.
But I do think it's going to get a little bit more challenging. I think we're looking outside. By the way, my view is to stay long the Magnificent Seven, in part because, I work with typically taxable investors, right? And so those taxable investors have realized huge gains.
Oh, they don't want to pay taxes.
I don't want to bet against those stocks. I think, it's important to have large cap allocation in a core portfolio, but we're looking a lot more to things like small cap. I mean, the economic numbers are definitely supportive of more cyclical stocks. If you really think rates are coming in, which I do, those companies have a lot more floating rate debt, and their valuations were still 20% off the November 21 highs versus S&P reaching a new high every day.
Yeah.
So that broadening of the market is something, I believe in. And then, the valuation supports it too. They're trading, Russell 2000 is trading at 2 times book versus its average historically of 2.2. It's interesting to me.
So it's going to be longer lasting, you think, for like the Russell, for example, to continue this run that it's on. I mean, I've had some people sit here and say, look, the Russell could go up 50% this year, because of all of the reasons that you said. Now, 50 may seem far-fetched, but the point is clear.
Yeah, I don't think 50. I think it has the chance to return, something in excess of our expectations for the S&P is that, another 7% from here, another 15% from here. By the way, the Russell typically outperforms in election years, too. So all those things, I tactically like Russell. I will say just generally on the market, I expect we'll get some volatility this spring or summer as we head into the elections. I think that doesn't start to happen until 2 or 3 months before. And I would tell clients to add on those dips. I don't think it's going to be a straight line up until the end of the year.
Have you had to kind of rethink? I mean, I know the firm has in terms of the first rate cut, right? It was like March, kind of double down on March. Jan Hatzius did. Then after the last news conference with the Fed chair, it's like, all right. May.
Yeah, so May, we expect 5 cuts starting in May. And I think we still believe that. I mean, if you look at, 6-month core PCE inflation, it's trending below the Fed's 2% target. So I think we still expect to see those cuts. If it gets pushed out from May to June, does that seriously impact the market? No, I actually think in some ways the economic data being strong is more important for the market.
Okay, interesting.
And so, yeah, I think we still see those cuts coming May or June. The official firm view is May.